Today, ladies and gentlemen, the bank's earnings, Canadian banks, Bank of Nova Scotia is kicking my TFSA in the crotch today as my banks seem to be getting hit harder and harder on every earnings call. As you can see, my Canadian Imperial Bank and my Bank of Nova Scotia, just in my tax-free savings account, are down quite a little bit, and they just keep on the downtrend because they're coming out with earnings. I want to discuss these earnings, what people think about these earnings, because they're a little confusing as it says, ignore Bank of Nova Scotia's earnings miss and buy its stock today. Well, why is that? I'll tell you right now, so let's jump right into this. Welcome back, ladies and gentlemen. I want to break down the Canadian Bank of Nova Scotia's and the Canadian Imperial Banks, and generally just what is going on with the banks of Canada. And we'll start by reading The Motley Fool. Canada's most international bank, Bank of Nova Scotia, reported some mixed and somewhat disappointing second quarterly earnings, 2019 earnings. The bank missed earnings despite a solid gain from international banking as well as global banking and market propelling its stock lower, causing it to be down almost 12% for the year to date. Is that true? I don't think that's true. Let's take a quick peeky pair here. What do we got? That's hard to say, because so here's the beginning of the year. It's actually up from the beginning of the year. So how did you come up with that 12% year to date? It's up. Stupid Motley Fool. That doesn't make any sense. How is it down 12% when from the beginning of the year it's actually up? You're already wrong. So that's a big red flag. I feel like what this guy did is, you know what he did? Sorry, I'm going to come back here. I think he went from like the top of this and then went all the way down. And even still, it doesn't hit 12% year to date. So I don't know where this guy, if we go all the way back, like if you find the peak, we're not even down 12%. Maybe if you go back into January, we'd be down not even 12% yet. So that is a horribly misquoted thing you're saying there, bud. For an article wrote about that came out literally today, you don't know what you're doing, Motley Fool. You're making me question. So I don't know where this guy came up with this article, but he's horribly wrong because it's actually up year to date. Don't know what you're going on there. Now I'm questioning the rest of this article, to be honest, if you're already wrong about that. Scotiabank, I can't believe you're already wrong. Scotiabank's woes can be blamed on a sharp uptick in provisions for credit losses and higher expenses. As a result, the bank reported earnings of shares of 1.73 on a diluted basis, which was 0.01 per share lower than the consensus analyst. So we're down 1 cent from analyst reports. You want to know how much that is, guys? You simply time 1 cent by the shares outstanding, which is 1.22 billion, which gives us about $12 million in losses. Let's just keep reading the article. Sorry, I'm already frustrated with how this article has been written. But while Canada's banks continue to face domestic headwinds and are attracting considerable attention from the U.S. short sellers, including the renowned Steve Eisman, who profited betting against the U.S. credit bubble, Scotiabank's latest decline has created an opportunity for investors. Now, Steve Eisman also said that this isn't like 2008, and he doesn't think these banks are going to go through a huge decline like it happened in the U.S. He thinks that they're not prepared for a credit cycle that might be coming in housing and whatever else, because if we know anything about the Canadian housing market, we know that it's been on one heck of a run and it's been slowing down recently. So at the beginning of this year, we've actually seen housing sales going back up because we've seen about a 15 to 20% correction, and now people are starting to find housing a little bit more attractive. But even still, housing is really expensive in Canada, and when you look at the banks, they have a lot of exposure, especially Canadian Imperial Bank, to housing loans, which can be a little iffy. But anyways, let's keep reading this article, shall we? Let's just keep reading here, guys. Key Scotiabank's misery was a worrying 62% year-over-year increase in the value of credit loss provision, which is what I was just talking about, to an $873 million, which is a lot. So they've almost raised credit provision up to almost $1 billion. And I think this is a good sign. I really do. Because this essentially is just saying that the banks are aware that they might be running into some headwinds in the future, so they're saving money today, which is what smart people do, to basically cushion any kind of issues they may run into. And we're talking about $1 billion cushion. That really helps, which was mainly driven by steep uptick in the provision of international banking triggered by a combination of unfavorable macroeconomics data from Mexico, recent acquisitions in Latin America, and hurricane-related provisions. What I find neat is Steve Eisman is smart because he kind of caught this trend before anybody was really talking about it, and now the banks are really pumping up their loan loss provisions. But it's smart. I mean, it's really gonna help basically investors like me be like, okay, you know what, the banks, they're not hiding from this. They're not being like, oh, you're wrong, no idea what you're talking about. They're aware that could be an issue. It's not that it's an issue today. It's just that it could be an issue. Not saying it will be, just that it could be. Unlike its peers, however, Scotiabank is positioned to benefit from the improved economic outlook of Latin America, which, because obviously they've been doing some acquisitions there, with its operations in the Pacific Alliance nations of Mexico, Peru, Colombia, Chile, acting as a significant growth drivers. So if you know what's been going on with Bank of Nova Scotia, they've been expanding their banks, other countries, guys, and we can keep reading this, but let me just scroll down a little farther. Global banking and markets also have returned to growth, reporting a notable 25% quarter-over-quarter increase in reported net income to $420 million, led by higher fee and commission revenues, which we know that's something banks are really good at doing. Although this was still down by 6% year over year, if the ruckus concerning fears of a renewed trade war between the U.S. and China dies down, the global banking and markets earnings should continue to grow as trading and capital markets activity increases. While adjusting expenses spike 8% year over year, almost $4 billion, they can be attributed to cost associated in acquisitions, including the completion of the purchase of BBVA Chile, which is what I was just talking about, their acquisitions in these foreign countries. So we get it, guys. We kind of get what's going on here. I'm trying to make this as easy to understand because banking can be really confusing to some people. But if we take a look, Bank of Nova Scotia actually just increased their dividends. If we go into their dividend payout, they've actually increased their dividends for the first payout this year to 87 cents from 85, and we can see they've actually been increasing dividends nicely since 2014. From 5 years ago, we've gone from 64 cents all the way to 87. Now, the other thing you want to be worried about is, can they afford these dividends? Well, if we look at their dividend payout ratio, I'm not going to completely break this down for you like a lot of investors will do, but you can simply Google Bank of Nova Scotia's payout ratio, which I can find right here somewhere. I already looked it up, which is about 50.87, which has actually dropped based on this year's estimates. We're looking at 42.87%, which is the payout ratio, which essentially just means if you divided out their earnings versus the cash flow they're paying to shareholders, it's about 42.87%, which is very healthy. It means they have room to grow. If they miss a lot of earnings, they have room to basically make sure they can still pay out their dividends. I love the Canadian banks. The Canadian banks were one of the few banking systems that survived '08 nicely. They were one of the few banks globally that continued to pay out dividends in the 2008 financial crisis. I love the Canadian banks. I love them. I love them. I love them. I use Bank of Nova Scotia. Obviously, it's my trading platform that I'm currently using. It's paying out a 5% starting yield right now. And what I consider buying this stock absolutely. And what I'm going to do is I'm actually going to set my stocks back up on a drip. I really like the yields these guys are currently paying out. And if this year the Canadian banks continue to be suppressed the way they are, I'm just going to set up a drip, and I'm just going to let my dividends come out of these companies, keep rebuying into them. You can see I have rather large positions in the Canadian banks. I also own Bank of Montreal, which has been my most stable bank, but it's also my smallest bank position. And honestly, guys, I'm a little disappointed with the Motley Fool. They already have so many inaccuracies, which makes me... this is why you have to question these things, and you should go into the Bank of Nova Scotia's books. I'm really breaking down an article I can't even trust because the first statement that they've already... Can I just reread this to see if I'm reading this wrong? 2019 earnings. The bank missed on earnings despite solid gains from international banking as well as global banking, and markets propelling its stock lower, causing it to be down by almost 12% for the year to date. So they're saying that the stock has been sent lower almost 12% year to date. What chart are they looking at that shows that the Bank of Nova Scotia year to date is down by 12% when it's actually still up 2%? Oh, I don't know. I don't get you, Motley Fool. You're going to have to answer that one. But I'm going to question any article I read from you from now on, because if we compare the Bank of America, we're looking at really similar PEs. Everything's kind of following the same suit, which is kind of incredible because if we look at, say, Bank of America, the year to date for Bank of America is actually doing quite substantially well considering compared to the Canadian banks. So the U.S. banks are doing pretty much a lot better, but their PEs are almost exactly the same. And I'll leave the link in the description below if you guys want to know more about the banks. I made a full video on this stuff. Banks are banks are banks. They all follow the same kind of suit. But Canadian banks, in my opinion, are better than U.S. banks. But apparently, Steve Eisman doesn't think so. So stay cool, guys. Stay awesome. I hope you enjoyed the quick video today. I'm going to try and make you another one. It's still pretty early. I didn't plan on making this video today. I was just looking at the bank's earnings, and I'm just shocked to see that they are down as much as they are down today, even though they only missed earnings by $12 million, which sounds like a lot, and it is a lot, but when you're talking about billions of dollars, it's chunk change. I'll talk to you guys very soon.